You were live.
We are live. What's going on, everybody? Today is Sunday, January 24th. We are
Excited to be here.
extremely excited to be here. We got a few things we want to talk about today. Just wanted to go over the schedule and what we're looking to chat about today. First thing we're going to touch on some of the content that we posted today. And we had a lot of people reach out on the this or that. So we wanted to touch on that. We had some pretty funny comments on the best comments. We want to touch on that first before we get into some of the actual content that we're going to talk about today. We'll wait for all you guys to get on here. Hey, what's going on, guys? What's going on?
Nice shirt.
We like the shirt. We decided to rock the shirts today because we know a lot of people are out there right now down south enjoying themselves, and unfortunately we are much too busy to be down there at the moment, but we still wanted to act like we were down there, so we thought we'd rock rubber shirts today.
Yeah, I think we had some stories that we had posted up there, just a little bit of this or that, and there were some good responses and some good picks, tough picks, but I think the modern day version seemed to be winning over, which I kind of agree with. I do like the modern takes a little bit.
Yeah, for sure. Taking a look at the ones on our story. If you guys didn't see it, the staircase. I'm a big fan of the modern staircase, the modern looks over the old looks, the old world looks. I'm a big fan of that. 77% of people were. Hey, what's going on, guys? Sean Walton, what's going on, guys? Thanks for tuning in.
I mean, it starts with the traditional. The traditional brought it, it's there because of the traditional look. So you got to give a little bit of credit to the traditional.
Agreed. We also have a handful of questions that were asked in our water slides. I love it. We had a bunch of questions that were asked from our followers on some of our posts. So we're going to go through those as well before we get into the nitty gritty of our content today. So if you guys have any questions, reach out. What's going on? Can you guys?
There was one more story, wasn't there? I think
there was a few more stories. Let's go through that really quick. Yeah, we can definitely go through the 20,000 down product really quickly. But if you want a more in-depth review, go to Matt McKeever's YouTube channel. We have about a 25-minute video explaining the entire product and how it works. Or you can just shoot us a DM and we'll be happy to go through it with you personally, man.
This one's interesting. This one's tough.
Yeah. So
I kind of like Building B, but I like the modern
Building A. Building A was definitely fortunately our guys on Instagram can't see it, but Building A was definitely the more modern look. Let's go to the next one. Pool. So you got like a little float around pool or like an actual pool. I'm going with the float around pool. I'm a big dinghy guy. I like just chilling and having it.
That brings me back to Wally World. A little lazy river type action floating around in the dinghies.
For sure. And last but not least, we had a best caption. So if anybody didn't see this, we had a picture of a less than stellar cottage. And the best caption was from Burner_24, which he said, "Welcome to the crib. Sincerely, Dirty Mike and the boys." Looks like a very Dirty Mike and the boys kind of place. So
not a place you'd want to park your Prius. That is for sure.
Definitely.
It's not the right place.
Not. Right on. So I guess what we wanted to talk about, we wanted to just go over the video that we dropped on Friday. We had a huge amount of people already watching videos, which again, we appreciate all of you guys who do that. Before we actually get into that content, we had a few questions we wanted to go over. One of the questions was vacation rentals using septic and well. What is the refi ratios and do banks recognize income? So first of all, vacation rentals in general are decently tough to get done. Depending on if it's a 3-unit or 4-unit, a 3-season or 4-season cottage is going to depend on how much money you have to put down on the property. There are a handful of lenders who will not lend on septic, and there are lenders who will lend on septic. So that's a really big thing when coming to financing a rental property. Some it's not in their guidelines to be able to lend in certain areas, especially if there is a septic tank or the water isn't municipal. So something to keep in mind. Obviously, depending on how difficult it is to finance, the lender might reduce the loan to value to make it less risky for them. If it's in a marketable area, obviously it's all about marketability of an asset. So if, for example, your asset is in the middle of nowhere and doesn't have any running water to it from the municipality, then it's going to be difficult to finance it because it's going to be less desirable than maybe something that's on market that does have those amenities to it.
Yeah, there are a couple of things you're going to want to get done if you are involved in septic. They will want to do a well water analysis just to make sure the water is safe. It's just simply taking a sample of the water down to, I believe it's the city, and they'll give you an analyst on the or an analysis on the water sample, and then they'll have an inspector come out and take a look at the septic tank as well to make sure it's in working order and that there aren't any any problems with leaking and environmental contaminations coming out of that. So like Josh said, it really comes down to marketability. If you're on a top tier lake in the Muskokas and it's a high target area, if it's a second home, I guess too is the other thing too is what you're looking to use it for. If you're just looking to use it as a rental type property and make some income off of it, you're definitely going to be scaling down on the loan to value. If you're buying it as a second home, you could potentially get it as an insured product and another second home. So depends what you're looking to use. And then the last part to that question was, what is refi ratio and do banks recognize the income? So if it is a second home and it's, full 4 seasons, you could be able to refinance it up to the 80%. Again, depends on the lender's risk for that area and the marketability on the property. And then do they recognize income? So if it's specifically for a rental income type property, and we're actually looking at a client who has a property that they're considering it's very similar to this. Cottages, cottages kind of scream Airbnb. It is tough to have a full-time lease and expect someone to live in a cottage full-time and full year round. If there was previous history of the building being used as a full-time rental and someone was living there, that definitely helps the case. And in that case, we might be able to use a full type of income for rental income. If there isn't any previous experience with it being a rental, the banks might look at it as an Airbnb. They might allow for, if you're trying to purchase the building under a commercial loan, they might allow for a market rent report to be used, deemed off of what they would see it going for an Airbnb. They might allow that. And that's something that we're looking at right now with Meridian. So it really comes down to the lender. More lenders, there are certain lenders have more, are more risk adverse. Some are less risk adverse. So depends. Once you get into that cottage area, credit unions really become valuable. They're in the area. They understand the area. They're usually the ones who put out a lot of financing on most of those cottages. There are some A lenders who deal with the larger ones, like those 1 million and plus. You can get the TDs and the RBCs out there to get it done for you. But it really comes down to the lender and what you're specifically using that property for and what the previous use of that property is.
So a good question just came in from Isla Homes. If you have a multiple investment properties, can you buy cottages as second home with less than 20% down? Essentially, yes. So, the second home program is an insured home product. So, if it is truly going to be a second home, like say, for example, we have a client right now, I was just speaking to them. Hey, Kellen, what's up? So if you, for example, had a area in which you worked in, so say from Ottawa to Toronto, and you had a house in Toronto, but you moved or you worked in between there and Ottawa, and you wanted to buy a house and it was on a lake, you could use the second home product and you could get an insured mortgage product as long as it was 4 seasons and it met all the criteria that was required by the bank. So in a nutshell, yes, it is decently difficult to sell that. Obviously, you're going to have some sort of verification to the bank to let people know or let them know that you do technically work out there and this is going to be used as a home and not like a short-term rental. It is important. It is going to be used as some sort of home.
Yep.
A few more questions we had come in before we get to the meat and potatoes of our content today. Is it true you have to wait at least a year before refinancing? Is there a way to speed it up when doing a BRRRR? So that is a myth. You do not have to wait an entire year to refinance. Obviously, the BRRRR would be not as effective if you did have to wait the entire year. Now, most financial institutions do like to see you own the property for a year. Can you do it? Yes, it's possible. So there are banks who will do it the day after purchase. There are banks who will do it 3 months in, 6 months in. If you are acquiring property and that property and that property was you bought it undervalued, for example, and you bought it with a private loan, but your idea was to do some renos and then refinance it in say 6 months. Like I would fully recommend in your numbers, run the numbers based off of 6 months of carrying costs for that private loan minimum. And then obviously we've done a BRRRR. I think the fastest was 3 months from ICICI Bank.
Yeah, it was 3 months, and it was out of a private. Once you guys are, so there's two things to keep in mind. Obviously, there's two thoughts from the lenders. If it's immediate, if it's within 6 months from the time of purchase, there are institutions who will consider the refinance, but they may do it at the purchase price. So you're essentially just doing like a switch or a transfer. So you're taking your current mortgage amount and you're getting out of an interest only, and you're getting into a principal and interest type payment. You're not going to be able to take out any equity, but they will get you into a better product. And then there are some lenders out there who will allow you to take out equity right away as well too. So we do have a lender on the A side who will, consider refinance relatively immediately. I think, after like 1 month of ownership, they'll allow you to look at refinance and pull out the equity. They might want to know why, why you're in that situation. Why are you looking to pull it out so much? How did that appreciation value come to be? So definitely make sure you keep track of your receipts of your renovations and the costs and everything, and have some proof that you guys, did some work to force appreciate the property. And that's how that new value is derived. And then depending if it's getting out of a private lender or not, sometimes they want to see the original private agreement. They may ask for 12 months of bank statements. So the one that we did at 3 months, they wanted to see all bank statements for the last 12 months from both borrowers for all the mortgages that were on and all the mortgage statements. So 12 months showing no NFS fees, so no missed payments, no bounce checks, anything like that. Just basically making sure that your credit is in good standing and there wasn't any issues. But it is a little bit more documentation getting out of the private mortgage, but it is doable. We have done one at 3 months before.
Yeah, it is doable for sure. Last question before we kind of get on to our content today was, I changed from full-time to contract this year, same job in IT. Can I qualify for a mortgage this year? That's a great question. So essentially what happens is when you are a full-time employee and you have guaranteed hours, a guaranteed rate, or a salary, we can use the salary or the guaranteed hours and rate to help you qualify. The lender is going to, if you're in a contract position, the lender is going to want you to see at least 2 years history in that contract position to be able to qualify. Now, if there are exceptions, like if you've been in the industry, say for 10 years, and you have a consistent year-over-year growth in that specific field, and your contract that you took is in the same field, making maybe more money, and you could show maybe a year contract, for example, and it was with the same company, you might be able to get away with proving the viability of that income over time. But the standard is 2 year history of a contract to be able to qualify for a loan. So if you are in that situation, I would recommend reaching out and trying to get an exception based off that.
Mm-hmm. The other option is there's B lenders, or one particular B lender that we work with who has a really great self-employed program where basically they will qualify you guys off of 12 months gross business statements. So just they'll take a look at your last 12 months. They'll take a look at all the cash flow that's coming in. So if you guys made $500,000, let's say, and you write down your income to $20,000 for that year, we can take that 500,000, and depending on what type of career you're in, there's a certain percentage of that income that we can use, based off of what field it is. So that's another option too. So if you've only been in your job for a year and you don't have that second year, we do have a B lender that will allow you guys to do a 1 year bank stated from gross income. So that's super popular. They have a great offset. It's a great product for business for self guys who are just in that first year and looking to buy a property.
Agreed. I lied. One more question, guys, just came in. So just want to check, what are the benefits of first-time home buyer? Can I qualify for a mortgage with just one notice of assessment? I'm a newcomer here in Canada. So that is a whole conversation on its own. Let me Cole's notes here really quick. If you're a newcomer in Canada, you need to either be a citizen or a permanent resident to be able to own real estate in Canada without getting hit with the foreign home buyers tax. Now, in regards to your NOA or T1 general, it really just depends on how you're paid. if you're a salary employee and you're permanent resident here, I can use your salary. It doesn't matter if we have 2-year history on your NOAs or T1s. So it's just a matter of figuring out how you're employed and then how we can use that income to help you qualify. So in the short answer, yes, depending on how you're qualified.
I think time in Canada has to be under 3 years, I believe, too. If I haven't done a first time, or not a first time buyer, but a new to Canada while. I think the minimum, there's very certain parameters for new to Canada. And I believe it's as long as you've been in the country for less than 3 years. So, but yeah, definitely feel to reach out to us and we'll clarify everything with you on that question. For
sure. I've got another question. When breaking a closed mortgage for a refi, does it depend on the lender on what your penalty will be? It depends on lender and product. Mm-hmm. So if we talk about this quite often, and in one of the posts we actually just made, one of our clients had a really good point. So there are benefits of taking maybe a variable on acquisition. And once you take a variable on acquisition, it has less cost to break your mortgage than it does for a fixed rate mortgage. Now, each lender has essentially their own way of figuring out what the penalty to break is going to be. So it's important to go to pick a product that works best for you and your strategy, and then really understand what it's going to cost to break. So usually, in a nutshell, a variable rate mortgage is going to cost you 3 months interest to break. A fixed rate mortgage is going to cost you either 3 months interest or the interest rate differential, whichever is larger. And we can go into, there's multiple different ways to get into how to calculate your interest rate differential. We actually made a video on it. It's going to be dropping, I believe, next week or the week after. So stay tuned for that. But yes, lenders do choose the penalty and how to break it differently than others. So important to keep in mind.
Yeah. And then one other thing that's actually, it's a pretty good lead into our, the video topic for today's live was, things to take a look for on your commitment that you may not, already know, or that some mortgage brokers, we know some mortgage agents don't go over the whole closing package with their clients. They kind of just ship them out and leave that due diligence up to you guys. We like to kind of sit down, have a session, and make sure all the ins and outs are discussed. But, just some things to be aware of for you guys when you are looking over the commitment, and just some things to keep your eye out on. So, first one that we kind of talked about on the video was the rate option plus. So basically there's a lot of really low rates out there, guys. Some of them, I think 1.35 right now with Meridian, 1.45 with ICICI on the insured side. But one thing to keep an eye out, if your mortgage rate is super low and looks super enticing, is making sure that it's not a rate option plus. So a rate option plus is essentially just a no frills mortgage. So there's no perks. You don't have any prepayment privileges. There's no portability, probably no assumability. And something that could be in those rate option pluses are the exit is only acceptable through a bona fide sale clause. What does that mean? Basically means that the only way that you can exit out of that mortgage is if you were to have a bona fide sale, a purchase and sale agreement, a firm offer, and a sale of the property. So, make sure you guys, if you are looking at a super low rate, just keep an eye out, ask your broker. If you don't see anything in there, making sure that there is, a standard exit clause and you're not limited to the sale of property.
Yeah, because that bona fide sale clause can definitely affect your ability to be able to tap into equity. So, keep that in mind. The difference between locking yourself into a mortgage for the difference between 10 basis points or 20 basis points isn't worth it, guys. Aaron and I actually refuse to put people in it unless you really are hell-bent on it. You don't want to be locked into a mortgage. It's the biggest piece of debt you're ever going to have. Having the flexibility to be able to do what you want with your home or with your investment is the most important thing. The $100 a year or $200 a year it's going to cost you extra really is worth every single penny when it comes to having to execute on your investment strategy, guys.
Mm-hmm. Yeah. And this is why we say, rate isn't everything. Rate is certainly a piece of the puzzle, but the bare bottom rates are often associated with these no type frills kind of things. So you really do lose out on the benefits. So just keep that in mind.
For sure. I think one of the other things we want to talk about was, prepayment privileges. So something to keep in mind with prepayment privileges, an average loan is going to have a 20/20 or 15/15 prepayment privilege, which means you can either put a 20% lump sum payment down every single year. It's not cumulative, so you're going to need to make your 20% lump sum payment throughout that calendar year, and then you're going to be able to do 20% the next year as well. You can also increase your monthly payment amount by 20%. every single year. Again, not cumulative as well. So having this flexibility to be able to make payments, additional payments to pay down that principal of your loan can be super beneficial if that is one of your strategies. So something to keep in mind that, those no frills mortgage products, they don't have those abilities, or they don't have as flexible of abilities to do it. So definitely keep that in mind. It's something that most people look over, but it's super important.
Mm-hmm. Penalty to break. So, just basically what we just touched on there with the closed type mortgages and what the penalties are. Just understanding what your penalties are, especially if you're looking to do some sort of BRRRR, minimizing the cost on refinance and exit is going to put a lot more equity back in your pocket. So we'll just touch on it briefly again. So, if you're looking at a variable rate closed product, it is subject to a 3 months interest. There are a couple ways that some lenders do calculate the interest. Sometimes it's calculated off of the prime rate instead of the contract rate. So just make sure you talk to your mortgage agent or look through the commitment and have a full understanding of how that is structured. The other is on a fixed mortgage. So on a fixed mortgage, you are going to have the interest rate differential or the 3 months interest penalty. A basic rule of thumb that we kind of use for our investors is if you're in the first half of your term, you're most likely going to be subject to the interest rate differential. And if you're in the last half of your term, you're most likely going to be subject to the 3 months interest. Basically just comes down to the amount of principal that you have, because it is going to be the higher of the two. So on the interest rate differential, you're essentially looking at the difference between your current interest rate versus what the interest rate would be for the time remaining in your term. So if you were in the first year of a 5-year term, they would take a look at your 5-year term versus the interest rate on a 4-year term, figure out what the difference is and calculate your interest based off of that differential. Whereas if you're, in the latter half of your term, you are looking at just the 3 months interest of what you currently have under contract for most lenders.
Yeah, for sure. Next is rental assignment. So some lenders are going to require you to sign the assignment of rents. Essentially what that is if, for example, somebody were to go power sale and you couldn't pay for your property, they have the rent assigned to them, meaning that they can take the rent and use it towards, obviously, the property once they take possession of the property. Just something to keep in mind. It's pretty standard clause now for any rental property. It's not anything you should be concerned about, obviously, unless you have full intention of defaulting on your mortgage. Just something to keep in mind that some people have questions about. That is a normal thing that most people who are buying rental properties and most lenders will require when closing on your transaction. Yeah,
it's always been around, but I think it's really popular right now with COVID. There are a lot of owners who are starting to defer their payments or have deferred their mortgages over the last year and a bit. And I think it gives a little bit of extra to the bank. It helps reduce some risk. If you were to default, they are still able to, bring in that rental income. So like Josh said, it's not a big deal unless you guys are planning on default. So just keep that in mind. Portability and assumability. So 2 clauses that are in the majority of contracts out there, not often used, but could be beneficial in some situations. So portability is essentially, if you picture your mortgage as a blanket, you could pick it up off of your current property and drop it or port it onto a new property that you guys were looking at. The amount that's going to carry over is just what is on your remaining mortgage balance. So if you were looking to, extend that mortgage and cover more of the cost, essentially you either have to put the cash down or blend and extend that mortgage. So what they would do is they would take your 1.5% rate, let's say, and drop it on there. And if the new amount was around 2%, they would essentially blend and extend that mortgage up into their approved loan to value on the property, or essentially you'd have to come up with the cash additionally to drop it over there.
We've got some renewal fees. So something to keep in mind, guys, if you guys are in a B product, depending on the bank you're with, they may charge you a renewal fee. Some B banks don't charge fees. Some banks do. It's usually around, I want to say $500 to $700 to renew your B mortgage. You don't have to pay that broker fee and lender fee again once you're already in, unless you want to tap into that equity and refinance with that B lender again. So Those renewal fees are there for most B products. They're not crazy outrageous fees. Little tidbit of information: if you stayed up to date and didn't miss any payments, you'd probably go and negotiate with the lender. They want your business, okay? Like, especially B business is decently lucrative for them. They want to keep you as a client, especially if you're a good client. So if you are coming up for renewal and you don't want to pay your $500 or your $700, give them a call, see what they say. They might be able to do something, they might not, but I mean, it's always worth a call. It's like Rogers, right? Just give them a call and they might be able to give you a month free or something like that.
Yeah, and something else to consider too is the renewal fees on some private mortgages. So we do have some clients sometimes who need to get into like a MIC type mortgage. There are some MICs that are relatively cheap to renew in, around that $250, $200. And there are some MICs who are expensive to refinance. And so if you're looking at a private solution and it's a 1-year term, and there is a possibility that you might need to refinance into that, make sure you look at the renewal terms. Are they going to charge you that 1% or 2% lender fee again? Do they charge the broker fee again? There are some private lenders who automatically charge the broker fee, even if we don't charge that. So, or if we don't choose to charge it on the second, they will charge that. So keep that in mind. Taking a look at what the renewal fees are and whether or not they charge their fees again can definitely be the difference between a $300 and a $3,000, $4,000 renewal fee. So
yeah, let's get into some fees for a second. So when we're dealing with mortgage investment corporations, like any bank, there are going to be discharge fees. So even if you have an open mortgage, there is still going to be a fee to discharge your mortgage. Now, most mortgage investment corporations have the outline of their fees in it. So when you're going through your package with your broker, make sure you understand all the costs. You're seeing really aggressive private money in the market right now. You're seeing 3.5%, 4.5% to like 5.5%, depending on your credit score, at 75% loan to value. Now, really aggressive rates, great for if you're in a situation where you can't necessarily show any income, but you want a low carrying cost for a certain term to be able to show income, but you want to get into a property. 5.5% is a great rate. Now, you have to understand that after that year term, there are auto renewal fees. So understanding all those costs factor into the entirety. So that 5.5% might look really, really great, but if there's a $2,000 discharge fee and a $300 wire transfer fee and a $900 administration fee and $1,800 auto renewal fee, and all these things start to add up, and that 5.5% is no longer 5.5%, right? That's a 2% or 1.5%, 2% lender fee. There's a broker fee, and then all those fees. So keep in mind that maybe that 8% rate on a mom and pop private loan isn't the terrible option if they're not going to hit you with a bunch of fees in the back end or the front end. So all things to keep in mind, but if there are really aggressive private options out there. Just want to touch on a few of those, those things.
Yeah, and just going back to the comments here, City here, how are you? One of the questions here from Osman: can you loan the renovation cost on top of the mortgage? So there are a couple products out there. One of them is the purchase plus improvement. So if you were doing an insured or an insurable type mortgage, essentially the lender will allow you to add up to about $40,000 onto your mortgage to cover renovations. It is like essentially held in trust. So it is a rebate type program. So you do need to have the renovation costs up front to be able to get it done. Once you guys satisfy the quotes, you can take that to the lender. They'll release the funds and reimburse you for the work done. So that is one option. Again, it does require you to have the costs or the cash up front to be able to do those renovations. The other option is looking at a private solution where you can use collateral equity to help increase the loan to value. So we have done a mortgage in the past where the client was able to bring us, it was a free and clear $1 million property. And I think he was purchasing a $400,000 property or something like that, where there was more than enough equity to get the loan to value. I think we had it at 115 to 120% loan to value. So not only were we able to get him into the house, with no down payment, we covered his fees. We covered, I think, his interest for 6 months interest, and then his renovations as well too. So if you guys have a property that has enough collateral on it, we can just increase the loan to value high enough that you can essentially use that down payment as your renovation cost. So that's really the second way to get that done. For sure.
Another question just came in is, do you have short-term private lending for 3 to 6 months? So the great thing about private lending is we can actually be super flexible with it. So if you only need it for 3 months or 6 months, there are 6-month open products where you're not going to get hit with a cost if you break before the term. Again, those 6-month open terms, 75% loan to value at 5.5% rate, they're a phenomenal product, but you need to dial in your time frame, because if you're not, there's no renewing that mortgage. But the guys who are offering really cheap private money at very flexible terms, if you are going to do exactly what you say you're going to do and you only need it for that time frame, it's great. But if you are going to go over in your project estimations, then it could get decently costly, and you'd have to get into another product. So so the short-term money definitely there. You can get it. You can get completely open terms, 1 year completely open terms, depending on loan to value. So there's definitely options available if you were looking for a short-term private solution.
Yeah, one thing to remember with that is conventional lenders want to see the project at 97% completion. So, if you get stuck in a 6-month mortgage, and at the end of the 6 months, you're backed up and you're not fully renovated, you're in most cases not going to be able to refinance into a conventional mortgage. So you're going to be stuck just auto renewing back into that private. And again, could be a relatively cheap renewal fee, or it could be an expensive renewal plus fees again. So just making sure you understand that ahead of time. Question here from Rahul. Are there any lenders that would consider more than a 50% rental offset for a high ratio mortgage? So on the A side, which is where you're going to get those high ratios, I think there's only really one lender that does an offset, which I think there are some programs at TD where they will do a true offsetting. There are some lenders on the A side who do a debt wash type program, where they essentially take a look at the rental income coming in. It's essentially an offsetting, but the problem is that they only do 50%. So I think Merrick's essentially does a offsetting program, but again, they only allow you to do 50% of the rent, which in most circumstances isn't really enough to get the affordability to where you need it to be. The other disadvantage with that particular product at Merrick's is they actually drop the debt ratios. Your max TDS, I think, is only like 40. I think it's only 40%, whereas most lenders are 44%. And they want a credit score of 720 right now for all rental products. So, they have a cool product, but they really limit your TDS. So you only get to use half the rental income, and your TDS qualifying is 4% lower than a traditional A. So it's a super tight product. So in short, no. Yes, like TD does have a specific product, but most of the lenders, no, you're really stuck at 50% of that rental income.
Yeah. Another question came in: which banks don't charge penalties on fixed interest if you want to stay in the same bank but would like to change from fixed to variable rate? I don't know any banks that don't charge a penalty on fixed interest rates to break. I don't think there's any at the moment. I don't think there's.
But if you want to stay in the same bank, so you might be able to look at a switch or a transfer. So if you're not looking to pull out interest, or not interest, but if you're not looking to pull out equity, something that you could consider is a switch or a transfer. So this would work if you have a high interest private, and you just wanted to get out of that. Or if you were, transferring from a B, maybe you got a better job, your pay is increased, and when you first bought your property, you were just stuck in a B solution. You just wanted to transfer into a better product. You could take a look at a switch transfer. There are some lenders who I think can cover 3 months interest, if I remember correctly. I would have to double check the product. But in terms of just being able to switch interest rates at a bank or just switch products, I haven't heard of them not charging that because it is you're changing the term and the interest rate. You really are just breaking the mortgage. So, if you went to a big six bank and you were able to negotiate with them, they might be able to do that for you. But most of the lenders are going to charge you some sort of penalty for breaking your mortgage and getting into a new term and product.
For sure. Got a few questions coming in. We got one from Matt Carr here. It says, "Hey, gents, can you shed some light on lending opportunities for storage unit properties?" I haven't come by a storage unit property before, but there's a handful of things I do know about those types of properties. One, it's going to be zoned commercial or some sort of industrial, depending on obviously the property you're looking to do. If you're looking to build a storage facility, then you'd have to obviously own the land first, and you'd have to have some sort of construction mortgage facility to be able to build it. And then from there, you'd have a takeout at the end. Now, I'm sure it'd be quite the same as rent, for example. They'd be able to hypothecate how much income you'd be able to derive from each individual unit. And then from there, they'd figure out your estimated NOI. And then it'd be a lot like a commercial loan. So I'm going to assume that the property would then debt service itself based off of the amount of projected income it would have. And it would be a lot like just a multifamily, but you'd be able to qualify based off of the operating income. Now, I could see it obviously being a little bit of issues in regards to takeout financing, because it would be an estimate of a value, and it wouldn't be like a fair market rent, for example, or it wouldn't be an actual lease signed. So there might be some challenges with building it and then having it vacant. But purchasing one that is already pre-existing, you could, like any multifamily, you would have financials from the seller, and then those financials would go towards the NOI, and you'd probably have a debt service coverage ratio on that specific property, and there'd be a minimum amount that the lender would require to be able to get a loan for that type of property.
Mm-hmm. I think, and then the other type of option would obviously be if you were to buy a piece of land and just put storage units on it for your own type of use. And I think in that situation, you're really just looking at a land loan, essentially. If you aren't actually building anything on it and you just want to use it as a storage piece of land, and 55 cents on the dollar, you're gonna have to come up with at least half of the purchase price in cash. And then like I said, if you're just using some storage containers, you're really just looking at a land loan at that point. You're not gonna get much higher than 55%.
Phil Yona came in and said, an investor run to the top end of one bank's mortgage limit, example 4 or 5 mortgages. What is the next best option beyond that? What are the examples of rates and terms on those products? This is our bread and butter, guys. This is what we do for a living. This is our targets. Essentially, this is the ideal client for us. What we do is we take a look at, so that limit on 4 to 5 rental properties is essentially a limit on the bank. So a bank will only allow you to purchase so many properties within their specific bank, because you have a certain risk portfolio. And if you max out that risk portfolio, they're no longer able to extend you some sort of credit. That's nothing saying that you can't go to another A bank and qualify for a loan. If you qualify and your GDS, TDS are in line with them, you can go and purchase a property with them, because they'll have their own max that they would allow you to purchase at. If you are tapped out on your TDS and GDS ratios, then what you would do is we would look at an offset instead of an add back, and we would look at those B options. That is essentially how we get people from property 4 to property 8. You start, as long as your first 4 properties are cash flowing, there's a handful of different products available. One, it would be a debt servicing worksheet that would show a surplus or deficit. You could wash all those properties and use the surplus of income monthly, add it to your income, and then qualify for your next property, essentially washing all the debt you have on your other properties, or just using an aggressive offsetting feature from one of the banks. These rates are roughly right now high 2s, they're around 2.94%. Depending on your credit score and loan to value, and they go up depending on the lender to around 3.5% or 4%. Really aggressive rates, really aggressive products. If you are going to get into a B loan, this would be the time. They're historical low rates right now, and even for a 3-year term at 2.94%, guys, that's what a AAA loan was last year. Like, that's the difference between you owning 3 or 4 properties and not owning any property like that. It truly is unbelievable what these offsets can do. Now, some of these lenders do have requirements when it comes to how much of that rental offset you can rely on. Like, if you have $25,000 of income and you're 100, like almost 100% of all of your income is being derived from this offset, some lenders are just going to be like, you're relying too heavily on the rental income to qualify, which is understandable. There are other lenders out there who do offer the same products, but they do want to see some sort of reliance on your personal income situation as well, especially when you start getting into 5, 6, 7 properties. They want to see you guys have the capacity to be able to carry these loans.
Mm-hmm. Guys, you can actually get into a owner-occupied property right now on the B side for 2.74. And this is pretty unique, because if you take a look at the way we qualify on the B side versus the way we qualify on the A side, The A side, we qualify the stress test. So a stress test right now is 4.79. So no matter what your rate is on the A side, you have to qualify at 4.79 or 2% above your contract rate, whichever is greater. So the majority of the rates right now, we're qualifying at 4.79. If you wanted to buy a home right now and you were to qualify for 2.74 on the B side, you're qualifying at 4.74. You're actually 0.05% cheaper, or reduced interest rate qualifying wise on the B side than you are on the A side. So you could actually afford a better property and a higher property on the B side versus affordability on the A side currently. So it's a kind of unique situation where previous to, most of the times when you're qualifying for a property on the B side, you're qualifying quite above the stress test. But we're actually at a point right now where you can qualify cheaper or qualify at a lower stress test on the B side than you can on the A side currently. So,
which is wild.
Yeah, which is pretty crazy.
Question for Dane Guilford. Guys, going to sell my property in April and mortgage comes up in March. What is the best option to go? Should I go variable for a year or something else? Want to avoid the penalties? Well, Dane, if you plan on selling the property and you want to buy another property, just get something that has some sort of portability. Lock in or get in either variable or fixed rates, and then get something with that portability options. Sell your home, pick up your mortgage, drop it on your other property, and then just blend and extend your rates depending on obviously how much your home is and how much more loan you need. That will reduce any cost for penalty for breaking, and you still get to renew at a decent rate. So I recommend that before locking in like a 1-year term, for example.
Mm-hmm. There are some open rates on the B side. Like I think Equitable has a 4.5% fully open. So that is an option. It is a higher interest rate, but it all depends on the situation and what you're looking for. And then Jenilyn had a follow-up question here. So just a follow-up to that question from earlier. What if the property is negative cash flow of $200 per month, but property appreciating $100,000 per year and property is 60%? What was the first question? Let's test my memory. Which banks don't charge penalties on fixed interest if you want to stay, but you would like to change? This one you might just have to reach out to us. I think.
Yeah, it sounds a little bit complicated. Let's definitely reach out and touch base to see if we can find that solution there.
Yeah, anytime you get a lower loan to value, like especially on the B side. So if you're 65% loan to value on the B side, just for example, that kind of takes them out of their a certain target risk portfolio that they're typically in when they're above that loan to value. So they can actually get super creative on the B side and really start to kind of just bend all sorts of rules when they're at 65% loan to value. So just as a general kind of comment there. But yeah, just definitely reach out to us so we can get a better and more full understanding. Can't speak right now. Better understanding of the situation so we can give you a better answer.
For sure. I think we actually caught up on the questions. One of the other conditions you're going to want to keep track of on your commitment is going to be reinvestment fees. So not all banks have this, but some banks do. So if, for example, you go into a 5-year term and you want to break your mortgage, in the first year, some banks such as MCAP have this reinvestment fee where they're going to charge you $500. Now, if you break it in the second year of your term, it's going to be $400. In the third year term, it's going to be $300. After the third year of your term, there is no reinvestment fee. So there is a little bit of a penalty to break your loan early in the term, even if you do have a variable rate mortgage. So just something to keep in mind that they throw in there to dissuade people from taking like a 5-year term and then breaking it. As you guys know, or as we've explained before, banks project their total income and they borrow based off of their projected total income. So if they get you in a 5-year term, they're basically locking in their total income over a certain period of time, and they can borrow money based off of that projected income over a certain period of time. So they're going to want you to stay in that term if you're locking in for a 5-year term. So that's why they have that in there.
One other thing to take a look for is skip a payment. It's not often included in commitments, but there are some products out there that would allow you to skip a payment. You would have to reach out to your bank ahead of time. This isn't something you can just kind of play down like a get out of jail free card. If you missed a payment, you do have to structure this ahead of time. But keep an eye out for that. just on your commitment, could be something that definitely could come in handy in a situation like right now in the pandemic. So, if you're curious, take a look back through your commitment, see if that option is in there. And if you need to, reach out to the bank to be able to utilize that. And then understanding your variable lock-in. So you guys can, if you guys are aware, if you guys get into a variable rate and the rate starts to fluctuate high enough where you kind of get out of your comfort level, you can lock in that interest or that at that interest rate to stop it from fluctuating any higher. And then just being able to understand what that means. So most lenders, what they want is your new rate or your new term of locking in has to be somewhat equivalent to your original term. So for example, if you had a 5-year variable rate and you wanted to lock in, it has to be equal to that 5-year term. So what they do is they take a look at what your new term is going to be plus the term that has expired, and that has to be equivalent to that 5-year. So if you were to exit out in your first year, your new term would have to be 4 years. If you exited out in your second year, you'd have to have at least a minimum of a 3-year term to be able to equivalent the 5-year term in total.
For sure. One other cool thing that is in some commitments that you either may not know or maybe may want to know is that most lenders offer the ability to pay your property taxes with your mortgage payment. Some people just couldn't be bothered. Sometimes they get into a situation where they'd much rather pay this bill instead of that bill. And if you get behind in your property taxes, it's a pretty serious thing. So there actually are clauses in a lot of mortgage commitments that state you have to keep your property taxes up to date because then they'll put a lien and it'll get a bit messy. So most lenders, what they do is they allow you to pay your property taxes monthly with your mortgage payment. Now, when you initially lock in or you get your mortgage, they have something called a reserve. So on closing, they will take X amount, whatever that is. Some are 4 months, some are 3 months, some are 6 months, whatever it is, and they'll hold it in reserve. So they pay your taxes quarterly. So they'll have a reserve. So they'll always be paying that property taxes for you. It might look like you're double paying your property taxes. You're not. They just do that because they need to have money in that account, depending on where you're at in your payment cycle for your property taxes. If you have a home equity line of credit product attached to it, like the HELOC for MCAP, they take your property tax payment out of your HELOC. And then what people usually do is they usually just pay it off after they take it out. But it's a great thing. One less thing to think about. A lot of our clients just kind of keep it on autopilot.
Something to know too, if you're building a brand new home and MPAC hasn't been able to go out and verify those taxes yet, they will take a look at the city's mill rate. So just to be aware, oftentimes the mill rate is much higher than what the average homeowner is kind of paying in that time in that city at the time of when you're moving into that property. So I've had a couple of clients where they purchased a brand new build and the amount of taxes that they were being charged for the first year or for that first little bit till MPAC was able to come out and do their assessment was substantially higher than what their actual property taxes were. So just kind of keep that in mind as well too if the lender is paying your taxes for you and those taxes haven't been determined yet by MPAC.
For sure. We actually just got a question from Multifamily Amanda. Can you use land owned free and clear as a down payment for construction loan? Yeah, I believe they use the equity position in the property as collateral to be able to issue you the loan. So what would happen is if you owned it free and clear, that would be whatever it is, say 500,000. That's an equity position to able to start the tranches for your construction. And usually it's in 3 separate tranches. The first tranche is, I'm not going to get into it. It'll take us forever to talk about it. But yeah, the equity position can be leveraged to be able to build a property. Yeah,
and it's actually a very important topic too, which we could probably take a look at or have Scotty discuss at some point as well too, is what that equity position is and not being too quick to pull out that equity and leave you in a very minimal equity position. If you are looking to move forward with a construction project, having that strong equity position is very crucial to getting, any type of bank type lender. If you take out that equity too early, it can actually really hinder your ability to move forward and can leave you kind of in a shitty situation and stuck with a pretty expensive private construction. So we can talk about that at a different time. That's a whole nother rabbit hole.
That is a hour-long conversation we can have. We did have a question from Bob Proctor here on YouTube. Thanks for tuning in, guys. On new condo purchases in 2019, presently in occupancy stage until April 2021, do lenders ever look at present value compared to purchase price? The 99% of all conventional lenders are going to go off the actual purchase price and not the actual value. That's why people get a mortgage and then they break the mortgage and refinance into the new value, obviously, to get that cash out. Are there lenders? I think I heard of one. I could double check for you. The majority of them, it's no. I think there may be one or two that do allow you to do that, depending on how much, like, obviously the situation. I don't think it's going to be an A solution. I honestly do think you're going to have to be in some sort of B solution to be able to take advantage of that. So there are upfront costs to be able to do that, but I think you'd just be weighing your options. Does it make sense to close on it conventionally, break your term, and then refinance and pull that cash out, then just close B option? So all things to consider, but I think there might be one or two, but generally, no, you're not allowed to.
Yeah.
I think that's it for the conditions, guys. We did go through some of the cool conditions that we find that people had questions with, or that they just want to understand. For all the people on Instagram who tuned in today, thanks so much. If you haven't already subscribed to our YouTube channel, please do. We are trying to get our numbers up there. We are almost at 400 subscribers, which is unreal. We are going to keep pumping out content for you guys. We kind of like the way we structured it today, in which we had a bunch of questions to answer. So throughout the week, if you have any questions, shoot us a DM, or we'll drop one of those questions in our stories again to allow you to drop any questions. We'll try to answer as many as we can during our live streams, and appreciate you guys tuning in. It's always a good time. We're actually going to turn our live stream off this time instead of just talking after, but appreciate you all. Thanks so much for tuning in, and we will touch base again next week. Take care.
See you guys.
Bye.